California banking regulators have moved to now shut down Silicon Valley Bank and the vehicle by which they do it.
The FDIC just reported that California regulators shut down Silicon Valley Bank.
It's the largest bank meltdown since the Great Recession more than a decade ago. Silicon Valley Bank, a bank that caters largely to startups and venture capitalists in the tech world, collapsed this week.
Is one of contagion. That is, what we saw in 2008 was when one big bank and a couple of others started to fail.
The second largest bank failure in United States history.
It's really across the board.
Hey, good morning, everyone. Welcome to a special report here at the World From Here. And we've had a lot happen just this week with banks, a test of the banking system, Silicon Valley really scrambling, stocks being tested, big banks. And is there a new model for all of this? And I'm joined, as always, here with Mr. Tim Vasco, who's the founder of BlockCerts Blockchain. Good morning to you, Tim.
How you doing, Dan? It's great to be here again on a Friday morning and talking about a crazy last week. A week ago Friday, I think we saw Silicon Valley Bank collapse.
We did. And, you know, over the weekend, we're going back and forth going, oh, my gosh, if something doesn't happen by Monday, this could be a collapse of the banking system. And fortunately, some things did happen, and it's been an interesting week. And because of that, we also have brought on Mr. Robert Gerrard, who is our in-house director of finance and is our expert in the banking area. So glad to have you on board here with this call.
Good morning, Dan. Thank you for the invite. Look forward to having this great discussion. It's going to be interesting.
It will be. So to kick this off, take it away, Tim.
Well, basically, I'm going to look at my my texts here because I got so many questions on when the bank collapsed, and one of the things I just decided to do was to write a text and post it because it was just easier, Dan. So here's what I'm going to say about why it happened, and then we're going to talk about we are on the world from here, right? So I guess we talk about the world from here. So first of all, the why, and Bob, after this, let's jump in and really deep dive. But my question was, well, they over-leveraged on tech bets and tried to hedge with conservative banker mentality. It's like a tanker crash on the ocean where all the oil's spilled and people are wondering what to do next. Here's what happened. They put up a ton of cash to support the businesses that had business models from the VCs, and all of those deposits went into Silicon Valley Bank. There was about buckets of cash sitting in Silicon Valley Bank, about $208 billion. The business models of startups that didn't have a clear path to revenue were funded from the last round of financing they could raise over and over and over again. That's the traditional Silicon Valley Bank startup business model. And it's kind of like a giant Ponzi scheme. The bank, being bankers, thought they were in the clear because they were placing all those deposits into, quote, safe government bonds. Then the government bonds are only as, quote, safe as the interest rates in the broad economy. Well, as interest rates rise, bonds are locked in at lower rates. Their intrinsic value goes down. Why? Because the latest bonds are issued at much higher interest rates, and then so the lower bonds are stuck at that lower rate value until maturity. Well, since these Silicon Valley businesses are struggling to find cash flow business models and they're waiting or dependent on the money they have in the bank, they go to the bank every week to make their expenses and payrolls and withdrawals. It's how you run a business. But the bank locked up all that money in these low yield, quote, safe government bonds. And the Fed has aggressively been rising interest rates. So when they needed to get more cash to distribute out, then all the Silicon Valleys who had stopped putting VC money into the small startups, they had to sell their, quote, safe bonds before they matured at full value at a big loss, and it was around $2 billion when the bank collapsed. So the business customers, the small businesses, everybody had their money in the bank, keep going to the bank to get the money out, and the bank doesn't have it, and they ran out of money. So it's kind of a giant Bernie Madoff VC thing. And as soon as the deposits from the last funding round stop, the bonds had to be sold at losses. The companies can't get their money, and it's a run on the bank, and the game is up. And that's a very quick analysis of all the questions I got. And it's like last week we were talking last weekend and about why this happened. And Bob, you've been in the banking industry for your entire life until you joined us at BlockCerts, and you and I actually met. You were a banker when I met, and Bob, our director of finance, is gonna let's have a chat about that.
Yeah, no, I agree. I think when it comes down to all of this, you look at it, is the old banking model not going to work anymore in this day and time. Basically, you've got your demand deposits that are instantly available, and they turn around and take that money. They've got to do something to earn interest on that, and their interest based upon longer term derivatives such as U.S. Treasuries, loans they make for cars, loans they make for homes, or business loans or whatever. And as you said, SVB was a niche business bank. Their deposits, their demand deposits only accounted, their insured demand deposits only accounted for a little over 10% of their whole demand deposit. Most of it was what you said earlier. It's the VC money, putting it in for corporations to run their business.
And you just make a really good point, Bob, which is that traditional banking was lending against hard collateral, homes, cars, personal guarantees that had homes and cars behind them. Right? What we have are digital business models that have, how do you secure that? You can't, right? And that's the idea of venture. That's why it's called venture capital.
Yeah, exactly.
Right?
Yeah. And SVB was, it was basically the bank was solvent. They just had a liquidity problem. Their assets, they were investing in good assets. Even the loans that they did for these, that they were loaning money to the VCs for them to invest in the various tech companies, startups, or whatever, was at a 50% or lower loan to value. But the question is when, due to inflationary times, can't raise any more capital, they drain those accounts pretty quickly.
Exactly.
And so therefore they needed the cash.
And they're going out and taking this capital they had sitting in the bank and doing what a conservative banker would do. Go put it in a long-term bond at 2% and then leverage on top of that. Except that's not their business model. They didn't even understand their business model is these high-risk startups.
I was going to say, there's definitely some mismanagement of the bank itself in doing their interest rate risk management. They didn't do a good job there, obviously. And of course, the regulators didn't do a good job in watching the red flags. The growth of this bank, the growth of the bank was tremendous over the last 2 years. And so, that also is a red flag that the regulators should catch, but they didn't. But what I was going to say, the collateral that you have that you were talking about, I mean, it's not easily liquidated. It's not quick. And even if you can liquidate it, like you said, interest rates have gone up 500 basis points since they made these loans. The value of those bonds were, a third less than what they actually paid for them.
Right.
And so therefore, when you compound it, you become a liquidity problem.
Well, and you can't run. This is the exact example of some of the things and some of the misunderstandings of the economy and this type of business and technology today. It's happening all over the place. It's old business models, old thinking and mindsets that are set against this highly speculative world of inventing new business models or new technologies and so forth. We saw it in crypto. We saw it with FTX. We saw, this big hype of FTX going out with one guy, Sam Bankman-Fried, at the helm. One guy took that down. Let's be realistic here. That's not decentralized.
I was going to say, it's supposed to be decentralized, but it's centralized.
And how can one guy commingle funds into other assets and other classes that take the bank down? And it reminds me of one thing my father-in-law, it was the best advice he ever gave to my wife and I, which in Charles Schwab, there's one little box that you can check or uncheck that's on margin. And that was the best thing that advice I ever had, is not to have things on margin, because when those calls come in, you sell everything at a loss and you're left with nothing. So it reminds me of what just happened here.
Well, and that's exactly what's going on. So as we go through this, and we're looking at all the reporting and the doom and gloom of what was going on. But as Bob said, the bank itself wasn't unsolvent. They sold those bonds at a discount.
Right.
So understand this too. All that value, when those bonds mature, is still there. Somebody bought them, and somebody's
they're still worth $1 million once they mature.
Yeah,
but
somebody's going to make a killing on that. Right?
Yeah. Somebody who has a long range perspective.
That's right.
Well, you know who has it though.
The government.
That's how the government came in. And
that's right.
Unfortunately, they waited too long to make this decision, which perpetuated all the social media and overhype of banks. All the banks are in trouble. But they basically created a facility that now allowed the bank to borrow at full face value that $1 million bond. They can get the $1 million to liquidate it, and now that bond is now held at the government that then owns that bond going forward. And they've actually have now, I don't know if you've seen it, but they've actually opened that facility to any bank. Any bank that feels they're going to get a liquidity issue or a problem, they can now go and take their bonds. If they were to go to the market and sell it, it would be at a discount. They can go and place it at the bank, and they give at the central bank, and they will give full value of that bond to create and stem their liquidity issues that goes on. Which, another thing that this brings up, Tim, is the insured depositors versus non-insured depositors, because the government has set a precedent, and it's going to be interesting if this happens, if and when this happens again. And, a normal FDIC insurance is $250,000 per account or per account holder. They now have taken that out of, because most of the account holders of these demand deposits were not individuals, they're corporations that had millions of dollars in their accounts at this company, and they're insuring those. They're basically making them whole. So now, does that set a precedent going forward for any other bank that's happening? Does that, now the FDIC is now, right now after this, I read something earlier that their reserves have gone down to, they're less than 1.36% coverage right now on their reserves. So they're really low on their amount of reserves that they have. going forward. So that means they got to go back to their member banks, raise their fees and their rates like they had to do in 2008 when they paid people out for the insurance. And now they've got to go and back. Guess what? Another obligation by these big banks that they have to pay to be a member of the FDIC. So now it's more money going out the door as well.
And Bob, we were all there. In fact, you and I were working together in 2008. Mm-hmm. And I remember distinctly calling you and saying, "How are you doing?" You go, "Oh, that's okay. I only have like a 2% exposure." I remember that conversation very well. And we all got creamed from that. I think we did. I don't think this is systemic like it was in 2008, for sure. But there are similarities, and there are also the same kinds of financial risks, with one big exception, and that's the business we're in, which is this idea of kind of decentralized finance, DeFi, the digital currency market, and the things that happen so fast now, which are alternatives. And at the World From Here and at BlockCerts, we've been talking a long time about how VC is over. And I think I read in Bloomberg, it says VC is now irrelevant, right? And so when we look at that, and I think I can even share that, little blip, which is that the venture capital loses its relevance. And there you go. The venture capital loses its relevance after the SVB fiasco. Have we reached the points where startups will bypass VC firms and just go straight to billionaires for funding? So when you read something like that and you're wondering, well, Will, is that really kind of where we're at in the market today? You also have to ask, or what else? What other alternatives are there for capitalizing these kinds of businesses? And do we need a VC and Silicon Valley Bank anymore? Is that the best model? Clearly, I don't think it is the best model. Clearly, there's better models out there for funding startups, innovation, small businesses, and that's really where the crux of it is.
Well, it is, Tim. And when you think about the banking system, it's the oldest business, hundreds and hundreds of years, and we're in a digital age, and the banking system needs to catch up with the digital age. And that's what we're starting to see here is new models and new ways to collaborate, coordinate, and to build for people all over the globe to build versus for the limited few that are able to go to a VC.
Exactly. And less than 1% of VCs actually ever, or businesses that go to a VC are ever actually funded in the first place.
Right.
So was it really a good model to start with? But what we were talking about is, the idea of this relevance of the venture capital market, the self-selection of kind of the good old boy crowd versus the market. And, it reminds me of the Constitution DAO back in, I think it was 2021, where in 2 weeks, two 25-year-olds said, let's go buy the Constitution. And they formed a DAO on the blockchain and raised $47 million, right? Wow. And ultimately, they didn't get it, and that's a whole other story. They bid against, again, a billionaire at Citadel Capital, Robert Griffin. But the point being that model was a fantastic model to show a change. And I think back then, Bloomberg actually wrote something that said, does this signal a change? So that was 2 years ago almost now. Does this signal a change in the way money, capital, nonprofits, and so forth are going to be raised? So I think in the next few World From Here's, Dan, we should really talk about how this blockchain market shapes up. There's a lot of, issues out there about what's a security, what's a utility, and so forth. But the handwriting's on the wall. This certainly the these centralized exchanges don't work. We saw that with FTX, and the VC to banking nuances like Silicon Valley Bank and Signature Bank, who also went down, don't work or are not working. So in there somewhere, there's a message of what will work. And I believe it's going to work on blockchain, both with regulation, more real-time regulation, and managing these things, creating real collateral, as well as creating the opportunities, like we know very well, being a blockchain business that supports and builds small businesses and puts these things together, way better ways to create new business models and funding models for the market, and right. Safer.
And Tim, you were just talking earlier today about the decentralized autonomous organization, the DAO, and how that's gaining relevance with new states. So
that's right. So New Hampshire, Utah this past week, and joined Wyoming. So it is now a legal entity. And I think we're going to see a real emergence of the ways to use blockchain and these financial structures that will reshape the way we can do this in the future. And I think, little prequel for the next world from here, decentralized isn't really decentralized ever.
We like to talk about it being decentralized, but there's got to be somebody.
Right. So we'll do a deep dive on the DAO and what is centralized and what is decentralized and what is partially centralized and what are business models that can become distributed and decentralized. But somebody always starts something.
Right. Has to start somewhere.
Exactly. So, it's fascinating to be here with you, Bob, and with your experience. As you know, you've lived this, you've been through it many times. And so thank you for joining us today and giving us a backstop as to what happened with Silicon Valley Bank. I have been known to call it Silly Valley anyway, so I wasn't really that surprised. And I do think that it's good that we have the startups in that community backstopped by the government, because it shows how important this kind of innovation is in our economy. And, now we start addressing the systemic risks and ways to reshape the systems in a much better way. That fosters success.
And I think it's going to be interesting with the government and how they're going to react to this, and what is and what's going to be is there a permanent solution? Is there we've got a temporary one in place right now. As long as we continue to fight inflation by raising interest rates, you're going to continue to have assets on these banks' books continue to deteriorate in value. Are they going to, reduce the amount of increases that they're having, that the Fed is presenting each week? I think we got another Fed meeting next Tuesday. It's going to be interesting to see what they come out with and decide on their on the increase in the or are they going to leave it the same? You asked a month or 3 weeks ago, 2 weeks ago, it was going to be somewhere a quarter to half a point raise in rates.
Yeah.
Now, it could be nothing. It could even be reduced. I'm hearing advocates on both sides of the fence on that.
Well, I think that what we'll do is keep this dialogue up, because it's certainly going to be a shifting set of circumstances. And that's what we're here for. The world from here, to start both analyzing and looking ahead at where the world's headed and what kind of support technology, blockchain, AI, and all of those things are going to have as we shift into this new future that we're facing.
Yeah, and also we'll be talking about transparency and what blockchain can do, because if a number of things were put in place prior to this, which is something that needs to happen, there are triggers that would go off before they have. So there's some interesting discussions that we know that are going to happen, and we're going to be talking about new business models, new ways of doing business, blockchain, and tokens, transparency, et cetera. So more to come on this one.
Exactly. So if you're out there, subscribe if you like our channel and give us a thumbs up. And we'll be back with a lot more information and deep dives on how this affects you, what you can do. If you're a startup, tell your startup friends to join the world from here, and we'll have lots more information and insights about exactly that, the world from here. But in the meantime, everybody have a great weekend. Thank you. And thanks for joining us as always. We're here for you.
Thanks, everyone. Thanks for joining us there, Robert.
Thank you,
Bob.
Thanks for having me on. Take
Okay.
care.
Take care.